This chapter will talk about our fixed assets or our long-term assets, property, plant, and equipment, and intangible assets, and some of the special accounting treatments that go along with some of these assets. So here's an overall summary. So we've got our property, plant, and equipment, which is land, buildings, equipment, machinery, furniture, cars, and trucks. So again, very common in most all of our companies. If it's an oil and gas company, they could have oil or gas deposits. If it's like a minerals, or like a paper construction place, they could have timber tracks. So again, these are going to be far more like niche type companies. So all companies pretty much have property, plant, equipment. Not that many companies have natural gas or natural resources, but some do. And then intangible assets also could be very common, though, for almost all industries. So patents that protect product designs, copyrights for music and movies and works of art, trademarks that protect logos and trade names, franchises. That's how a lot of people enter into their own businesses, is buying a franchise license, say of like Subway or McDonald's or Pizza Hut or UPS store. And then goodwill is when we acquire another company and we pay more than their book value. So again, this gives you a description of all of those different ones. So land improvements was one that wasn't on that last slide that we'll talk more about too. And then these are the types of acquisition costs that can be charged to these assets. So notice, like as we kind of look through them, it's basically what this top line says. All expenditures necessary to get that asset in condition and location for its intended use. So it's going to include like your transportation costs, if you had to insure it during those transportations, any taxes that you have to pay, if you need to run through tests or have it, like properly set up in some way. Say it's vans and you've got to put your logo on them. So all those things are costs that are necessary to get it ready for its intended use. Now, like buildings and land, you can have like title work and commissions for the real estate brokers, and those kind of things. And then again, if there was anything that needed to be done to the land to get it ready for its intended use, which is probably to build on. And then our intangible assets, patents, again, like I said, protect the design of a product or the process that's being used. And the thing is, though, you have to purchase those. So we do not, like notice it says we do not capitalize. If we created that patent and we had a research and development department that created it, or we had chemists or doctors or whoever's working on these things, those are research and development costs, and those are not capitalized and they're not included in the cost of the patent. So only if we purchase it would we be able to record that in our books. Same with the copyright. If we purchased the rights to that movie or that song, or the legal fees to protect it, say we did write the song, if we had to, file, which you do, to get that copyright protection, you got to go through attorneys and pay filing fees. All those things would be included. Again, same with the trademarks. Then there can be, again, franchises is a common way for people to get into a business that's recognizable and on their own, but it's also expensive. Could be hundreds of thousands of dollars. So that franchise fee that we pay is what we would set up as an intangible asset. Software development, again, any cost incurred after it becomes technologically feasible, but not including, again, that development stage. So the costs have to be after we kind of researched it and figured it all out. If we acquire research and development instead of having our own people do it, that would be one we could put on our books. But again, we have to purchase it. And then, like I said, goodwill is the excess paid over the fair value of a company that we are purchasing. So then our property, plant, and equipment and these intangible assets could be acquired by any of these different ways. So we could purchase them, We could make them. It could be donated to us. We could merge with another business. We could exchange, asset for another type of an asset, so a piece of equipment for a newer piece of equipment, or we could lease it. There could be long-term leases that we enter into. And so again, same thing down below as what we had on the other slide. Our cost is going to be our purchase price plus all of the expenditures necessary to bring it to its intended use. So then the cost of equipment, purchase price, sales tax, transportation costs, any expenditures for installation and testing, legal fees, and again, kind of any cost necessary to bring it into that intended use. So then here gives us a numerical example of what all is included in there. So again, it's all those examples we just went through. They might be all paid to different people, but in total, we'll put them all into the one account relating to this piece of equipment. And then land, like we said, has purchase price, attorney's fees, real estate commission, because we're purchasing it. We'll have to do a title search, and then record our lien. And then again, make sure, like if we had to pay any back taxes, make sure all those taxes are either paid up. If we have to pay them, that would be included in our cost. The current portion, like what we owe for after we purchase it, would not be included, but any taxes that we are assuming from the previous buyer. And then if we had to, again, clear the land for building. Oh, then this bottom part says any salvage materials that we would sell would then reduce the cost of that land. Because sometimes, say you have an old barn on it or you have timber, you could sell those things. So again, here's an example. And they're just showing you that it's the delinquent property taxes only. Those current year property taxes would not be part of the cost of the land. So we would not include those in there. Then land improvements was one we didn't really have on that initial slide. And those are things that are permanently attached to the land. So like if you sold that land, you couldn't pick them up and take them with you when you go. So like a parking lot, a driveway, a fence, sprinkler systems that are, inside the ground, maybe lighting systems that are inside the ground, or lights outside your park, in your parking lot. Those are things that you can't take with you, and they do get used up over time, so we do depreciate them. I didn't mention that on the last slide for land. Land is not depreciated. Land improvements are depreciated. Then buildings, again, very similar to the land, purchase price, commission, any legal fees. Now, if we were going to remodel it or refurbish it to put it again into the intended use, so say it's an old building, an old house that we're going to convert into office building. So whatever the costs would be necessary to get it into that condition that we want it to be in to use it. The natural resources, like I said, not all companies have these. If you would work at an oil and gas company, this would be their major asset, is having oil and gas deposits. So if you purchase them, it'd be your purchase price and any cost necessary to bring it again to its intended use. If you develop it yourself, you may have acquisition costs to acquire it, exploration costs to determine if the mineral deposits are there, or there is natural gas or oil under the ground. And then there's going to be developmental costs and then restoration costs. So like, say, let's think of a natural gas well. We got to put the actual well in there and in order to get the lines and everything to get to the gas and to pump it out. But then at the end, when that oil and gas well is done, we've got to restore it back to an environmentally safe condition and get rid of the actual, pumping device. I can't think of the actual name of it. But what that is, that liability that we have is called an asset retirement obligation, or an ARO. So if we know that when we, again, drill this well, that it's going to last maybe 5 years and then it's going to be dried up, we need to be able to plug that well and then return it back to its condition before we put the well in there. So then we come up with a liability to say, okay, that maybe is going to be another $7,500 that we got to put into this property. So for each well that we have, we set up that liability. Just so we're showing our investors, it's not like we can just walk away from these things. Environmentally, we have to, complete what we started and then bring it back to a safe place for people to either live or walk on or whatever. So then we'll try to measure it, and there can be a present value computation to it. Because like I said, say you're drilling that well, you're not gonna abandon it and for maybe 5 years, 10 years, something like that. So then you don't necessarily, maybe today it costs $7,500 to plug it, but maybe obviously as inflation goes up and cost goes up in the 10 years, it could be a higher value due to the time value of money. But then this shows you that, okay, like, so now this is a mining company, so a little different. They've got the right to explore a copper deposit on 500 acres of land. So they're going to be exploring that land, digging, looking for where those copper reserves might be. And they're going to put in some sort of a mine shaft to get to them and to get it out. And while they're, so their workers can be safe as they're doing it. And they purchase some excavation equipment, a total of $600,000. Then they're retired to restore it back to a condition suitable for recreation use. So again, you can't leave the big mine shafts in there. You can't, have it be at all dangerous. So then there's different outflows possibly, again, because they don't know, this is years down the road, they don't know what's all going to happen. So there's a 20% chance it's going to cost them $700,000, 50% chance $600,000, 30% chance $500,000. So we're going to average those out. And then, so I think here it shows you down below there. Okay, so we got the purchase price, the exploration costs, the development costs, and then now what's in red is the estimate. So again, we're taking each amount we might owe multiplied by the percentage it's likely to come up with an average. So we average that it's probably going to cost us $590,000, but it's not for 3 years. So then we put that into so again, I like to not use the factor, but put it into my calculator and say, okay, if my N is 3 years and my IY is 8%, my future value is $590,000. What would be my present value? What would that be in today's values? And then record that as our liability. So then if we come back over here, now we've got what's the journal entry. So we got the same costs, but so they're setting up an or a natural resource asset called Copper Mine, and it includes the costs. It includes all of those costs, including those restoration costs. And then they're paying the cash. Now that estimate that we did for the liability, we don't have to pay for that yet. That's not till the future. So that's where we set up our asset retirement liability. And then that liability is going to stay on our books. And then the equipment we do set up separately because that will be depreciated. So the mine itself would be depleted over time. We would use it up. Okay, then this slide again says, okay, now if we really get to the end and our actual restoration costs are really $625,000 and we estimated them to be $590,000, we would end up having a loss. So then notice over the year, we're bringing that retirement obligation up each year to get it up to the $590,000. Again, factoring in that time value of money. Then intangible assets, we amortize. So we calculate our costs, but again, purchase price, if we develop those intangible assets, we do not get to record that amount associated with developing, only the purchase price, and then any other legal costs that are necessary to get it protected. And then we would amortize it out over its useful life. If it has an indefinite useful life, like goodwill, we don't amortize it. So again, here gives you a nice little table of all the different types that we have: patents, copyright, trademarks, and franchises. What normally are the costs that go along with those? What is normally the life? And then again, you know, how do we amortize those? Goodwill, again, like I said, we have to purchase it, so it can be internally generated. So these are things that create goodwill that are things that we can't put on a balance sheet. So we got great clients, we've got trained employees, we're in an excellent geographic location. So maybe somebody purchases us because of these things. So the only way that that can get recorded is then if they purchase us and the acquisition price is higher than the fair value of the net assets, that difference is goodwill. So here they give us an example. So they gave up $180,000 in cash. The fair value of the identifiable assets is $250,000, but they're also assuming the liabilities, which are $120,000. So that's a net of $130,000. So they paid an extra $50 million to get this business, and that extra $50 million is going to be goodwill. Now they could also give up, they could also, no, this one, sorry, they acquired all of the outstanding common stock for $180 million, and then they assumed their long-term liabilities. So again, we just do that same thing, look through what did they get, subtract out what they owe, and then the difference is going to be going to the goodwill. And that is 50. Then we can buy, which this would be common, especially say like land and building, but in this case, the example is like we buy a whole fleet of trucks and we pay $150,000. Well, we're going to allocate that $150,000 to each individual truck that we're purchasing. This is probably, again, a little bit more relevant to say, okay, I'm buying an existing factory, and inside that factory, there's equipment. I've got a building, I've got the land, I've got inventory. So I'm buying all this stuff for a purchase price of $2 million. Is there an additional amount in there for the $2,200,000? Oh, no, that's a fair value, sorry. So they're paying $2 million to get it. So then somebody comes in and does an appraisal and says, okay, everything you're getting, if we bought it individually and separately, would be worth $2,200,000. So then what we do is we take each component and divide it by the total fair value to get to what percentage it is. And then we take those percentages and we multiply them by the $2 million that we paid. So then that's what this next slide should do. So again, we paid $2 million. We're going to multiply each account by their percentage and then allocate out accordingly. And then that would be our journal entry to put those assets on our books and to remove the cash. We could also acquire them through not giving cash. So we could issue them common stock. We could give them a notes payable. We could do other assets, you know, and do an exchange, or people could donate the assets to the business. So if it's the notes payable, just know that there's going to be interest involved in that. So either it's going to state what the interest is, and we're going to calculate what that is and charge it as interest expense and put it into an interest payable, and then the company pays it back at the end. Or if they don't, if they say, okay, we're selling this equipment for this price, and in 2 years they're going to give us the $50,000, we can infer what that interest expense is based on what the current rate is. But we do have to record that interest expense in each of those years so that our financial statements are properly accounted for. if we didn't have a price on the equipment that we're purchasing and we need to come up with a value and they're not paying until they're paying $50,000 in 2 years, we can bring that back to a present value. And again, I don't like to use those factors. I like to use like our financial calculators or Excel and say, okay, we're computing the present value of a future value of 50,000 in 2 years with a rate of 10%. And then the difference between what we pay and what we get back is effectively going